Hey, it's Andrew here from Mortgage HQ. Jarrod Kerr from Kiwibank. He's, correct me if I'm wrong, Chief Economist, and I was recently reading his Our Take, Kiwibank Economics, and I thought, why not just get Jarrod to come along and to talk about the economy and property? Tell us 2 secs about yourself, how you came to be at Kiwibank. If I saw you in academics back in the day, is that right?
Yeah, long time ago. Did a little bit of lecturing at Massey University. Then I was basically told to go overseas. They told me, look, off you go to Australia, and get involved over there. So I did, and I found myself as an economist after a few years in academia, and loved it. Absolutely loved it. Working on trading floors and large international banks. It was a lot of fun, and I then ended up in Singapore for a few years, which was great. But as all Kiwis do, we contemplate where do we want to live long term.
Yeah.
And my wife and I thought, no, it's time to go home. It's time to get back and put some roots down in New Zealand. So we moved back 4 years ago, and I've been loving every minute of it.
Yeah, I think as successful investing and just understanding business, New Zealand's such a small part of the world. If you haven't had the exposure to lots of different cities and markets and the way the news cycle works in other areas, it's very hard to, like, the New Zealand macro environment is like half of Sydney. It doesn't really count. So we're very reliant on what goes on globally. If you haven't had that exposure, then you've got to question how much knowledge you actually carry. You got to read widely to be able to make decisions at a micro level as well.
Yeah, so, absolutely. I agree. I mean, the global economy moves, in certain ways, and we are, heavily integrated into the global economy. So having a good idea as to what's happening in Europe and in the United States, and what global equity markets are doing, what global property markets are doing, it's all, very important, and it feeds back into New Zealand. And I think you're right. We need to have this, more open mindset, and we need to, be aware of what's happening offshore.
Yeah. Well, what I'm going to do is bring up your little file, and I think that the thing that grabbed me straight away is this cooling map, and I think it's a really good example of how quickly things can change, especially in New Zealand. So why don't you give us a quick little intro on what we're seeing here?
Yeah, so it looks a lot like a climate change map of some description, but it's not. It's we use a whole lot of economic data to come up with how well the regions are performing, and what's going on in property markets around the country, what's happening with population growth, what's happening with retail sales, traffic, all sorts of indicators. And we obviously compare them to what was happening last year. And you can see that little map in the bottom right-hand corner there. We were running red hot last year. The property market was running red hot. The economy was running red hot. Confidence was high. We had, very strong economy, and in just the last year, things have changed, quite dramatically. Things have slowed down already. Interest rates have been lifted quite substantially. That's, one of the major drivers. The property market's in retreat, and consumer and business confidence has been hit over the last 6 months in particular. So we've gone from this red hot economy to something which is a little cool, slowing down, and it points to, I think, quite a bumpy road ahead for New Zealand. We've got a central bank which is trying to slow things down. They're clearly being successful in doing that. Yeah, it's going to be a pretty bumpy road ahead.
Yeah, and I fear that the trend of going into this, like, less confidence, it's very hard to get out of, and it's self-fulfilling, because when people stop spending their money on things, then businesses can't open, they can't prosper, they can't give pay rises, they can't hire people, they can't forecast very well. And so it's hard to get out of the slump.
Yeah,
might be a long slump.
Yeah, no, you're absolutely right. I mean, we're behavioural creatures. We get a sense that things aren't great and the outlook is not good, and it becomes self-fulfilling. As you say, confidence falls, and when confidence falls, we stop spending, we stop investing, we sort of batten down the hatches, so to speak. And I think that's what's happening now.
Yeah, one part that really grabbed me was around the labour market being quite tight, and I've got a couple of different business interests. I see this from blue collar and white collar level, and both decent sized businesses I'm involved with. It's it's hard to find talented people, and I think that one thing that's happening that is often missed with the data around a low unemployment rate is that the amount of job seekers is quite high. People, and there's a lot of people that are not working that are not actually really looking for jobs. So it seems like maybe even like 10 or 11% of the working age population are sitting at home. So that there's a supply problem with trying to find workers. A lot of people don't want to work or can't find the right job.
Yeah, there's a lot of mismatch out there, as you say. There's a lot of jobs available in most industries that we look at, but the people that are left looking, don't have the skills for those particular roles. I know we at Kiwibank, we found it hard finding workers, and that's right from people in the call center, so relatively lower skilled, to the high end executives. It's been a very tight labour market. In fact, the New Zealand labour market is as tight as it's ever been. Unemployment rate around 3.3% is pretty much as good as it gets. And I think the fact that we've gone through this pandemic and our migration has been non-existent for the last few years, we've really choked off that supply of labour that we otherwise would have enjoyed over the last few years. And it's basically pretty much one of these experiments, right? It's like a great experiment. We've turned off the tap, and of course wages are rising and the labour market's tight. The big story out of yesterday's labour market report was not the fact that the unemployment rate was tight or anything else. It was the rise in wages. There was a real increase in wages, and that is what we're hearing from our clients. They're telling us, look, we're having to give 5%, 7%, 10% pay rises just to retain staff, and they're having to give even larger pay to attract staff. So it is a sort of a economy-wide issue.
Yeah, I'm definitely mindful of especially the people that are more entry level or lower wage staff that gotta pay to keep talent, because that people are gonna be trying to poach them. And I got a couple of guys that work in a warehouse level, handling chemicals and stuff. And a year or two ago, these guys might have been on $23 an hour. Now it's going to be 30 to 35 bucks an hour, and I'm still thinking even more. And I've got one guy who is on 25, 26 an hour, and he's a trained chemist that probably, if he could find the right role, should be on 40, 50. But some people are willing to start in that level to stay in employment. Others are not. So I'm finding that there's a lot of mix there, and it's a very confusing time for business owners to figure out how many people should you have. Should you be understaffed and accept that that's going to impact you and your team, or should you try to stay overstaffed, that you don't want to risk? You understand that you will lose people, and it's okay to lose profit, so to speak, because it's an investment in making sure you always have the right team size. It's a tough decision to make as a business owner right now, and I fear a lot of people are making that decision to be understaffed because saving the money for tougher time that might be coming. um, so let's move on to some of the regional stuff. I saw, especially, I was very curious about the Wellington market. My brother bought a house probably at the top of the market in the last year or so, and it seems a scary place to be selling property in Wellington at the moment.
Yeah, look, it's the whole property market's weakening, right? The whole property market is off from the highs in November, and we are correcting for some previous excesses. The gains that we had in 2020, 2021 were extraordinary and clearly unsustainable, but they were fueled by, you know, record low interest rates, and I mean record low, like lower than the 1950s,
Yeah.
the lowest interest rates, you know, in the history of mankind. Sorry, I turned that off. So, you know, there was a lot of fuel in the fire, and a lot of accelerant added to that fuel, and now we're seeing things, you know, coming around, and Wellington has had the sharpest turnaround in house prices to date. Auckland's following, and I think we'll see house prices across all regions fall by around 10% over the next year.
Yeah, I wouldn't be surprised. And you know, the if you look at the last 20 odd years of growth in property values, what you see is a fairly consistent trend line, except for the last 2 years, which has been a big spike. So if you follow the reversion to the mean, you know, you think about averages, you're either going to see a bit of a bounce dip or some sort of balancing back small dip, because you have to, in theory, stay close to that average. And it's going to be interesting to see how the inflation impacts the value of a property. There might be a lot of difference. There might be a lot of drop in real terms, but in terms of the dollar amount, they might stay flat. And it might, during that high inflationary time, it is confusing for people to understand the real value of things when you've got high inflation for a long period of time.
Yeah, you're right. We do live in a period of very high inflation. Our inflation rate of 7.3% is as high as it's been since the 80s. I mean, you've got to go back quite a while to see inflation at these sorts of levels. And a lot of the inflation that we have has been generated out of the housing market, house prices themselves, but also the cost of construction. We're all aware of you know, not only the labor costs in the construction industry, but obviously the materials, the issues with supply chain, the shortages, and you know, the costs of building a house in New Zealand have really skyrocketed in the last year. They're up about 30%, I think, in the last year, which is you know, unacceptable, really. I think our housing market is broken in some parts, particularly around, you know, the ability of us to supply homes. So yeah, we're living in, I think, fascinating times. House prices and the housing market is clearly cooled, and that'll lead to a fall in inflation, I think, next year.
Yeah,
we'll see inflation come off next year on the back of reduced activity in general, but, you know, particularly out of the housing market. So interesting times ahead.
yeah. The latest newsletter we sent out to our list was about the risks of new builds and long settlement just at the moment. I mean, you mentioned labor, you mentioned construction materials costs, and it's also, if you have a longer build time than was projected, then you also got to consider the extra finance cost. And there's a huge opportunity cost if you're expecting something might get built, say, in 9 months, but it takes 18 months or even longer. I've had plenty of clients and friends that have been waiting on new builds for many years past when the original date was to be completed, and that carries cost with it the whole way through. And people are living in a lot of uncertainty if they're agreeing to new builds and long settlements, especially with interest rates moving so much. They gone from 6% test rate to closer to 8%. There's going to be a lot of people trying to settle on properties that are worth less at the time of settlement than they agreed to pay. The borrowing the test rate for them is going to push their borrowing amount down, there's going to be a lot of people that can't afford to settle on properties they're unconditional on. And that might create a domino effect in some markets. I mean, tell
Yeah,
me
you're
I'm
right.
wrong.
No, you're right. There is an element of that. In terms of the total, property market, it's a small percentage. The amount that's being built and the amount that's being done is a small percentage of our mortgage book and of total activity, obviously. But that marginal buyer does influence the price quite a lot. And you're right, there are going to be some people out there who are in a situation where they're trying to buy a new home, and the costs and the time associated with building that new home are increasing. It's a real shame. I think it's an embarrassment of this country. Our housing market really is in a bad state. We've got a chronic shortage of homes, and we really struggle to build
There's a lot of
large
regulation.
amounts. Yeah, regulation.
There's a lot of
all of the above.
bottlenecks on products. Yeah.
All of the above. It's a real shame.
Yeah. No, we keep pushing past it. It's a topic I'm passionate about, and we could spend a lot of time on it. But just tread with caution in the new build space, in my opinion, unless you're buying something that's going to be ready soon. I saw this this traffic indicator and I thought that was a pretty interesting concept. So basically, you guys have tracked the traffic in different regions and seeing how many cars are on the road, and is that an indicator for activity and money. And like you said, when we were first chatting, is about a lot of people working from home, and that's an aspect of it. And the thing that I'm really mindful of is like, what is the second order, third order consequences of having less cars on the road? Immediately I was thinking about, okay, less people shopping in smaller retail shops. So I saw that you guys are referenced that retail spending is up. However, I think there'll be a big skew, 80-20 skew towards some of the bigger, places that people order online, or Kmart and the warehouse and things like that. The people that'll be really struggling is the small, traditional mum and dad owned retail shops in your main strips. If there's no foot traffic or, driving traffic to those shops, those places are going to be really struggling. The cafes, restaurants, gyms, if there's less people driving, there's less need for mechanics, for tires. There's going to be a lot of consequences of people having the luxury of working from home or not going out. They're doing things online. And we're seeing a real change into the way that people live their life and the way that money moves in our economy.
Yeah, and I think it's a structural change. I think it's something that's going to persist, and hopefully it does. I think we're more digital now. The digital economy is surging, and it has surged over the last few years. The pandemic really drove a lot of us online, and we've had a good experience. So we've enjoyed doing things online, and online business. The amount that we do online has clearly accelerated. What we thought was a trend that was going to take another 5-6 years has really been condensed into just a few years. And we're noticing it obviously as a bank, the reduced foot traffic going into banks, and obviously, most people prefer to do stuff online. I think for every 1,000 transactions that we make, 990 something of them are online. Very few
crazy, crazy.
are done in person anymore. So I think it's interesting. You make some really good points around it's probably better for the climate that we're not traveling as much.
Not good if you just bought a mechanic shop in Hawke's Bay or something, though, right? It's
yeah, potentially.
I saw this is more DIY morning coffees. I got a flash coffee machine for home at the start of the lockdowns, and I was very skeptical because I like going to get my cafe coffee, and now it's just what I do: make a coffee at home, 6 a.m., chuck it on. So it's definitely less for cafe owners from me on the coffee side. The thing that I had a question about was the impact of buy now, pay later. Like I've seen some stories out there about big default in that area. So I'm wondering about how much of this increased spending is actually gonna default, and what habits you guys are seeing, and whether that's impacting your predictions.
Yeah, the whole thing about lending is people are normally pretty good. You know, 9 out of 10 people, even higher, are pretty good and pay things back. Where you come unstuck, where things go wrong, is when there's a significant lift in unemployment.
Yeah.
And we're not anywhere near that at the moment. You know, we've got record low unemployment. People have got jobs generally if they want them, and they're getting decent pay rises. So we're in a very healthy position. And if you look at default rates across banks and even these non-bank lenders, they're very, very low, really low.
Yeah.
But where it goes wrong is in a recession. You know, things turn bad quickly and people
Yeah.
lose their jobs, and it doesn't matter how good a person you are and how great you are at repaying your debt. When you lose your job, that's it, right? You've stopped out. And when we stress test ourselves as banks, we look at unemployment, and an unemployment rate going up from 3% to 6% is not that bad. Going from 6% to 8% becomes a concern. You really start to see default rates picking up, and any increase in unemployment beyond 8%, you get this sort of exponential pickup in default rates, and that's based on, you know, past experience. So at the moment, households are employed, they may be taking on debt, but as long as they've, you know, got that job, they're going to pay it back. And of course, there are, you know, a few people who come unstuck along the way, and that's what it's all about. But at the moment, with a labour market as tight as it is here in New Zealand, I think we've got very low probability of default rates rising.
Yeah. Yeah. Oh, I enjoyed reading your Kiwibank managers quotes. I got a lot of them highlighted. I was very concerned about the region's apple industry in Hawke's Bay struggled with labour shortages, and this year's crop was left unpicked. That's not good.
Not good.
And, yeah. Reading in Wellington, impacts of COVID and isolation are very disruptive for business, obviously delaying projects and jobs from being completed. Like and the quote that I think is really sums it all up is the tide's turned, the bubble is deflating rather than bursting. So hopefully a slow, painful recession is better than a massive overnight one. Time will tell on that. No, I've said it before on some of our YouTubes, is for the real product market, you know, it's fine for us office guys doing data and mortgages. You know, it's not real life stuff. I got a chemicals business that we import chemicals in bulk, and we downpack them into smaller products that you see in supermarkets, right? So this you know, real stuff. It used to take 60 days to get products into the country from overseas, and used to be able to cash flow that in a way that it didn't tie up too much capital, and people were willing buyers quickly, pay on time. Now you're looking at 90, 120, 180 days to get stuff from overseas. There's problems with container ships. There's like the products have definitely become more expensive overseas. So your capital is being tied up for a lot longer. You're not cash flowing it. And then when it gets to New Zealand, there's less people to handle it, and it's hard to get it out the door quicker. And what I've found is, okay, you've got the increased cost of getting stuff here, capital's tied up, and it's more expensive when you buy it, and that a lot of businesses haven't been able to pass on the costs of that, right? So what you're getting is this big lagging like handbrake on businesses throughout the whole of New Zealand, that maybe cash flow they're going all right, but in terms of profit, the profit is dwindling. right? And that's okay. That's part of like a volatile economy, and that small, medium businesses, they should expect high profit, low profit. Like but you can't do that year and year and year out. Like if that happens for 3 to 5 years, it's going to be a big problem. And that kind of brings back to through long recessionary periods, in New Zealand or globally, how much are you guys making your predictions based on past information and past data?
Well, that's what we do. In a nutshell, is we try and learn from the past.
Yeah,
We go back, go deep into history to find similarities to what we're experiencing now, but nothing's ever exactly the same. The 2008 crisis was very similar to the banking crises we had in the 1890s, believe it or not. So
that's a long way back.
I know, but we seem to make the same mistake over and over again, right? 100 years later, there was exactly the same mistake being made with loose lending and the like. The pandemic, we didn't really have much to play with. We had to go back to the 1920s and have a look at the Spanish influenza, and you just try and learn from the past. That's what we do. But to your point, we are living in interesting times. Supply chains are an issue, and everything that you just said, we've heard time and time again from many of our customers. Our importing customers are complaining that freight costs are still very high. They've come off a little bit, but they're still sky high.
Yeah.
They're 5 times what they normally are, and the waiting times are long. There's still COVID issues in some ports around the world. But the good news, I was talking to someone the other day who's a large importer. He'd taken quite a lot of comfort in the fact that shipping costs have declined quite a bit in Europe and to the US, and that should ultimately filter its way down here. And he was also mentioning that there are a lot more ships being built, and they're coming online in the next year. So there was an undersupply actually of ships globally, which exacerbated the problems with supply chains. But now there are a lot more ships coming on board, which will be good. So based on what he was saying, I would expect shipping costs to be half what they are today, in a year's time.
So
and hopefully
here's a history lesson.
Yeah.
Aristotle Onassis, big shipping magnate from I think 60s. So I was reading his biography not too long ago. Interesting tidbit: he borrowed 40 million to build a whole bunch of ships, and he didn't put any of his own money to get that 40 million. He's a deal maker, right? He buys ships. But what happened is a lot of those ship makers or ship orderers, they would go to the ship makers, they would get a whole bunch of ships commissioned, but then what would happen is recession would kick in and some of those contracts get cancelled mid-process. So it's fine to have a lot of ships on the way. If they don't all arrive, then it doesn't have the market impact as we all hope. But even when they do come in, it's still quite a political environment getting those shipping contracts. Like it's got to do with fuel. If there's a shortage of fuel in any way, that's going to impact the amount of ships that can be on the water. How much of those cost savings, if there is more supply of ships and the cost of shipping goes down, how much is that is passed on? Very hard to tell where we are right now. I feel like China is definitely holding on to a lot of ships, and we're starting to get into a point where it's not economical. It's not an economic thing that we're assessing right now, is we're assessing political movements globally and whether we're heading to a point where China and America don't agree anymore and they're not going to work with each other, and whether what's happening in Europe, who's going to politically win that battle in the next 12 months, and how is that going to impact little old New Zealand?
I think we're going to be stuck in a rock and a hard place, going through what you're talking about there. The geopolitical risks that we have, on the horizon are obviously at a heightened level. There's a war in Ukraine, and China is in our backyard. So I think it's going to be a very interesting, not just 12 months, but I think few years as to how this plays out. We're stuck in a rock and a hard place where China is our largest trading partner by some magnitude, and our military and our country's history is obviously tied to the West. So this is going to be a very awkward period, I think, for New Zealand and Australia and many countries in years to come. So you're right. There's a lot of politics disrupting things.
And that's the thing is, how much are you guys trying to assess with the government changes that might happen next year with the election? So do you guys just try and predict up to that point and then say, hey, based on whoever comes into power that's going to impact things the most, or do you not put much weighting on who's in power in New Zealand?
Oh, we do. We're very fortunate as a country. I know it feels like we've got all these, problems and arguments and whatever going on, but when you actually step back, both of our political parties are quite centralist. You're not voting in a really radical person who's going to radically change things. That means that we have to, have a serious look at our economic performance. Labor or National get in, and there are changes that occur under different governments, but not enough to destabilize our economy at all. And if you look at New Zealand's election cycles and economic performance, things change, but not radically. Yeah, there's an election next year. We don't know who's going to get in, but the economic performance, the majority of it in train, regardless of who's in power.
Personally, unless I have a better alternative idea presented, I think it just comes back to business confidence at business owners, the small to medium players. If there's no confidence there, then stuff doesn't get done.
Yes, that's much more important, and it's much more of a concern to me than anything else, has been the drop in business confidence.
When you guys are forming your predictions, how does the balance of quantitative and qualitative work? Is it now you're 90%, 99% based on data, or what?
It's a good question. We go through the data process with a lot of rigor because it's what we can control, and it's what we can, a good handle on. And we know the lags, we know, the signals, what to look for. So we do put a lot of weight on data, but data is also only good up until a point. You do have to put qualitative lens over top. The data might be telling you one thing, but that something over here is going on that can quickly turn things. So we go through the process of running our models, and that tells us one thing, and then we step back and think, what are these broader issues that some of them that you've raised, how are they going to play out in coming years? And we try and find the right balance, but it's an imperfect science. It's probably more of an art than a science, to be honest.
You want to call economics a science? Go right on ahead.
Yeah, exactly. But someone's got to do it, and our job is more around risk mitigation, as far as I'm concerned. It's about coming up with scenarios. It's about telling clients there is a risk of recession. This is what happens in recessions, and this is what you should be aware of and potentially preparing for, because that is what's a risk over the next year. So I think these sorts of discussions help strengthen businesses when they think about the risk to their business over the next few years.
Property prices in 12 months, you're expecting 10% drop. That's what you said before.
Yep. Yeah, about that.
Yeah. Anything you want to add there?
Look, I think we're basically unwinding some of the excesses, right? I don't think the housing market's going to drop into free fall, and start declining in overly concerning ways.
It's just bad. It's bad for so many people if the property, it's bad for banks, bad for government, it's bad for property owners. There has to be something massively external that would cause that. Otherwise, politically, all the people that have the power, they wouldn't want that.
No, you want a stable economy, right? You want house prices growing at a stable, lower rate than what we've seen in recent years. You don't want the housing market going up 30% like it did, last year. That's just as bad as house prices falling 10 odd percent, right? And I think we're just going through one of these cycles where it'll iron itself out over the next 2 years. It's important to note that the housing market is still undersupplied. We're not in a situation like Australia where they actually built too many homes, too many apartments, and they saw quite a big contraction over there due to the fact that they had oversupplied the market. We don't have that issue. I wish we did have that issue, but we don't. So
how does the OCR changing and continuing to change, how's that going to impact things? There's been predictions about OCR changes that have been right and wrong from all economists. It's hard to figure out what is going through their head. How does the OCR impact us as property owners and investors?
So the OCR is the official cash rate, which is the cash rate that the central bank uses when it deals with the banks. The central bank is the banker of the banks, and they set the OCR where they believe will influence the economy for the forces that are going on. So when things slow down, when you have a pandemic, when you're trying to stimulate things, you slash the cash rate, and they put it close to zero, and that lowers all interest rates in the economy. And lowering interest rates means people are paying less, so they've got more money in their back pocket. Plus, they're more keen to take on debt, which is by design what happened over the last few years. We've seen an increase in debt in this country. Now we've got, we've had a demand shock. We saw quite a substantial lift in economic activity, and we've seen inflation running at very high levels. Now the reverse is happening. They're lifting the cash rate, and as they lift the OCR, that puts upward pressure on all wholesale rates. And then when we are interacting with wholesale rates, we're lifting our mortgage rates and our business lending rates. And we've seen mortgage rates more than double over the last year, as the central bank is lifting the cash rate, trying to rein in inflation. And as you say, our job as economists are try and figure out the cycles and what the central bank's going to do with the cash rate through those cycles. And right now we're saying the cash rate's going to be increased further towards 4%. And then I think that they'll be cutting the cash rate potentially by the end of next year as things have cooled right off.
Yeah, hard to tell. It just feels like the RBNZ is being politically influenced a lot more than maybe their mandate should allow for it. I can get away with saying things like that. Maybe you can't. It certainly feels like the RBNZ was distracted and that there was competing priorities, which creates stress for them, because if you have more than one priority, it's not a priority, right? And it's been interesting to see how the government has influenced what is supposedly an entity that shouldn't be politically influenced too much. And if you go and read up on the board members of RBNZ, there's a few question marks there of just really if they understand based on their experience, if they know what they're doing. You can comment if you want, but I'll keep moving on.
Look, I think one thing we pride ourselves on globally is the independence of central banks, and I think there is a argument that independence has reduced a little bit with quantitative easing around the world. But I look at the performance of our central bank, and they did what they thought they needed to do at the time. We were in a pandemic. We were all calling for unemployment rates of 8, 9, 10%, housing market corrections. That it was a dire situation. I do think they were late. With hindsight, they were late to start lifting rates and start unwinding their quantitative easing. It's easy to say that today. That's what history will say is that central banks globally were slow to unwind quantitative easing and lift interest rates. Yeah. And that's why globally we have an inflation problem. So the RBNZ is certainly not alone.
Yeah.
In fact, they were one of the first central banks to start lifting interest rates. So they were, less wrong than other central banks.
A topic for many books, I'm sure, and they might all come out after the fact with, like you said, hindsight as their friend. Let me choose my question wisely. Overseas markets. So researching lessons, Vancouver, Sydney, Melbourne, UK, like what do you think the markets that we can learn the most from for New Zealand investors?
I think Australia, to be fair, because we're very similar. We've got, basically we've got the same banks. We've got very similar protocols. We're very similar cultures. We love our bricks and mortar. We love our housing in Australia and New Zealand, and that's not quite the same in Europe and even the US. The home ownership rates in other countries are lower than here, even though it's falling. here and a bit of a concern. It's Kiwis do love their bricks and mortar. I think looking at the Australian market is very useful. I lived in Australia for 16 years, so the property market there is quite similar to ours. It's unaffordable, but it's more affordable than New Zealand, and that's because they had that supply response. They had a mining boom, which was incredible, and they threw all these resources into mining, including builders and construction workers that would otherwise have been building houses. They came up with a big shortage in housing, and then the mining boom ended. All these builders and construction workers went back into housing. They had a residential construction boom, which was incredible. They built thousands of houses and apartments, and then they oversupplied their market, and they had a correction. So that's my long-winded way of saying the supply and demand of the housing market is important. We have undersupplied.
Get all the Aussie builders to come over here.
We can't attract them. We can't pay enough.
That's because the wages are not good and the dollar is so weak. There's no easy answer, really, is there? Inflation and interest rates, lessons from history. What is different this time? Why are we not going to have 8 to 18% interest rates for 10 years like we've had in New Zealand before? I got a lot of debt personally. I don't mind if inflation is high for a while. As long as I feel like I can afford to maintain that debt, then it's all good. So I got that bias. I think we're going to have high inflation, higher than what you're saying, and for longer than what you're saying. Granted, I'm not the guy with the data. I'm not looking as closely as you. Why are we not? Why are we not going to have 5 to 10 years of an average of 7% or more inflation?
Things were very different in the 70s and 80s. The shocks that we had back then were very different and more persistent. And central banks weren't quite as aggressive as what they are today. You can see that central banks around the world, 55 central banks have lifted interest rates and lifted them quite materially in response to the inflation that we're seeing. So I think we're going to see a slowdown in global growth. I think it's already baked in the cake, and that's coming through, and that will lead to a reduction in demand for commodities globally, and we'll see commodity prices coming off over the next year. As we briefly discussed before, we're kind of hoping that shipping costs will come off, and hopefully the oil price, based on part of that commodity story, hopefully the oil price is a lot lower in the next year than what it is today. And I put that all down to the fact that these central banks have seen inflation. They don't want inflation to run at 7% for the next 5 years. They're going to do whatever it takes to drag that inflation down to 2%. Because if we wake up this time next year and inflation's still running at 7%, the RBNZ has failed their mandate.
Well, yeah, they're already failing.
They're already failing their mandate now. They're reacting to it, and it would be inexcusable to wake up.
Turning a big ship, though, it's
it is, and small rudder, like you say. But I think that ship is turning, and we're starting to see some downward forces already.
Yeah, I've read some competing insights that commodities have been priced relatively low for some time, and that it's definitely with shares priced relatively high and commodities relatively low, that there's time for some crossover, and that during recessionary periods and challenging times economically globally, that money does flock to commodities. So hopefully whatever happens with commodities, it's again, the people that don't have that much money are the people that are impacted no matter what. I think that whatever happens politically next year, that election plays a massive part because of the tendency of the left-leaning government to keep the people happy, with more benefits, more handouts, and it doesn't matter which way you look at it, like that costs taxpayer more money. That brings the confidence down for business owners if they're sharing a lot of their profits in that way. I'm probably weighting the political impacts more than maybe most economists do. And I think a lot of small business owners are talking that way to say, hey, it does really matter who's in power. So what your team, blogs, subscriptions, papers globally, like if people want to stay up to date with what you deem to be as important information, where do you start your day?
It's a good point. I'm lucky. I have a subscription to Bloomberg, and Bloomberg, I think, produces some excellent cutting edge reports, and they're not biased. They're just straight up. This is what's happening. I read the Financial Times. I think you've got to get the right news. So I think the FT again is one of those publications that that you should scroll through. Obviously, you have to pay for it, like many things, but this goes back to our introductory comments, right? I start my day offshore. I start reading the international news before I open the New Zealand Herald or Stuff or anything locally, Business Desk, the like. So that's where I start my day. Being an economist, I tend to read a lot of economic reports, whether it's out of the Reserve Bank of New Zealand or the Bank of England or the like. I do like to try and keep up with the way they are thinking about things, but that's probably not of any use to your listeners. And I have a passion for the housing market, right? So I do like reading, the real estate, .co.nz and these sorts of their data we use, CoreLogic and the like. We use their data religiously. So getting a feel for what Barfoot and Thompson and the likes are feeling is really important.
Yeah, and trying to get data that's not too old. I was reading the real estate.co.nz latest report, and from memory, their feeling was, okay, yep, it's a buyer's market. Things have flattened, but it's not a bursting of the market in any respect. It's just there's more properties for sale. People don't have to rush or spend money that they didn't necessarily need to spend. Like when there's twice as many people looking as there are houses for sale, that's hard. When it reverses, it's actually probably like a better, safer environment for everyone, because a lot of buyers can't afford more than one or two valuations or too many legal fees when they're trying to buy a house. So I definitely see it as a positive that there's a lot more listings than there was last time. I think it's more than doubled on average across the country, the amount of listings this month versus 12 months ago.
Yeah, and that is partly a function of properties not selling too, right? So total listings have increased.
I think once they have their period of uncertainty impacting their decision making, then they see like, okay, it's just last year was hot, this year is cooled, and now we're kind of on that flat, just right Goldilocks is sleeping period. Then people hopefully will just get on with life. And a lot of people, say a teacher and a cop moving from Auckland to Waikato, they're going to buy a house. They need to buy a house. So people don't stop buying houses unless something really drastic happens, and unless China and the US and Russia and all, like, as long as the war stays local or political instead of physical, probably should be all right. All right. Anything else you want to add? I've kept you a long time, Jarrod.
No, it was a good chat. I enjoyed it. Thanks for inviting me on.
I appreciate it. Just hit subscribe, and if you got any questions, let us know below.